Birth, college, marriage, buying a car, buying a house, starting a business, having money for emergencies, retirement, death, and having a family legacy. These are the 10 most costly life events that we could go through in our lifetime. Wait. Actually, I forgot one. Hold on. Taxes. So imagine if you could take care of all 10 of these things and potentially not pay taxes at the same time, and it was through life insurance. Like, yeah, I know. It sounds crazy. You probably hear all these things on social media, trending and whatever that's gone viral and on different videos, but it's the real deal. And if you stay with me to the end of this video, I'm going to break down and show you exactly how I have this set up for my own family, how I even got started with one of my kids at just 4 months old, like shortly after birth, and what we plan to do with it. And so before that happens, please make sure like and subscribe to the channel. So then it's only going to help the channel out and going to help be able to spread more knowledge to more families. So everyone can know how to do this for their own family or their business or whatever investments and plans that they might have. So that life insurance policy I'm talking about is an IUL. It stands for Index Universal Life. Just to really sum it up in the most basic form is if this is you and you're paying your premiums into the life insurance policy, just like any other policy, right? You get a death benefit that comes with it. Essentially, you die, the death benefit gets paid out. Now, because it's a permanent type policy that accumulates a cash value, which I'll explain how that works after this, the cash value is what you can withdraw, or you could take policy loans, which most people are talking about, hey, how you could borrow from it. And then you could use that to cover those major life events like we were talking about, to cover like college, a wedding, could even use it in a more sophisticated way and buy some rental properties, even use it to supplement your retirement. So to explain how the IUL actually grows the cash value and kind of how it works more fundamentally, and slightly a little bit more detail, is these four, pretty much in these four steps, right? The first one are you're paying these premiums that go into the life insurance policy. Now, a portion of those premiums are set to cover insurance fees and costs, things that actually would pay out the death benefit. And that's the life insurance portion that everyone knows about life insurance. Now, here's the thing and the trick about IULs of how to use it properly to max out the cash value. The net premium. So that is essentially all of the premium beyond just covering the insurance fees and costs now gets allocated across different index accounts. These are like the S&P 500, global index. There's some different small mid factor indexes as well, and all these other different indices where that's how essentially it grows the cash value. So after the net premium is allocated across those index accounts, it gets to the fourth step, which is the performance of those index accounts with consideration of a floor and a cap will now determine the cash value growth in a tax deferred, really like tax advantage way. It's just technically the taxes are deferred, but if you're not fully surrendering the policy, you're not paying taxes on it, and the death benefits paid out tax free as well. So what this might look like as a quick example of like the net premium, just for example's sake, so it makes sense. Like let's say hypothetically the insurance costs are like $100, right? Let's say every month $100 would just cover the insurance costs to pay out like the death benefit. But instead of paying your premiums of $100, you're actually paying $500. You might be like, wow, that's ridiculous. Like, why would I want to pay that much in premium if the insurance cost is only $100? Well, the reason is because the net premium would then be 400, right? 500 minus 100 equals 400. That can straight just get allocated across different index accounts like the S&P 500. So that is how people are able to really max out their cash value and use it for things like to supplement their kids' college, to cover weddings, down payment on homes, starting a business, getting rental property, supplementing retirement, having something for emergency situation, and then still have the death benefit coverage at the end of the day. So the next thing I want to discuss is actually what this floor and this cap is all about, because this is an extremely important factor that determines the cash value growth. So let's hop into it. So to hop into explaining the different floor and the cap and how that determines the cash value, like I said, the net premiums, or some people want to call it like if they overfund their IULs, will get allocated to an index like the S&P 500. So an IUL has this floor or the cap. So what this means is that because it is not directly invested into the stock market, this is a huge thing. It's life insurance. It's not a security. Um, what happens is the life insurance controls the money and what's going on, but the performance, the cash value is based on the performance of like an index like the S&P 500, but with a designated floor and a cap. And a lot of people like this because it's an index way of growing your money. So instead of it being fixed, like a lot of people have their money in the bank, it's a fixed like 0.01% or whatever, then it doesn't do that much. The stock market directly in it, it's variable, up and down. Sometimes it's great when you're younger, not really great as you get older. And then there's the index way of money where it's locked in growth every single year, where you have guaranteed minimums, but still the potential to grow. This is that idea where for most companies, it's a 0% floor, meaning almost like the minimum guarantee is like you don't lose your principal. Some companies even have a 0.75% guaranteed minimum, which isn't bad at all. I mean, it's still better than a lot of bank accounts, right? And then a cap or like a maximum of 12, 13%, depending on what the index that you're allocating your net premiums to. So how this works is, let's say in the actual S&P 500, one year it averages, let's say like 5%, right? This means in that same year, your IUL would mirror the 5% because it's right here. It's within the floor and the cap. So it would be like for like. But if it happened to maybe get 20%, you would be capped at 13%. And you might be like, well, that sucks. Like, why would I want to have this cap and limit my growth? And it's the protection part of that IUL growth that people love. So we all know this grows variable. It goes up and down, like we've seen in so many years of different market crashes, with the real estate crash in '08, with some things around the pandemic. It's always bound to happen, and you can't really time it. So what happened when during that time period, let's say a market crash of minus 20%, the floor is zero. So all of a sudden, it's 0 or 0.75, depending on what IUL you have and which company, meaning that your principal would be protected. You wouldn't have a 20% loss. Because in reality, let's say you have, just to make math easier, um, let's just say you had $100, right? I love using $100. And you lost 50%. Once again, just so the math is easier. you would now have $50, right? So most people think, okay, well, if I'm trying to get my money back, I lost 50%, let me gain 50%. But that's not actually true, because what's 50% of $50? $25, right? So if all of a sudden you added 50% or $25, now you're at $75. So you didn't even get back to where you were before. So this is so crucial, where people, as they age or get ready to retire and they have huge crashes, they have to prolong their retirement just so the value of their accounts can catch up, right? So that means, who wants to work an extra 3-4 years just so their value can catch up? So this is why a lot of people prefer, maybe at that time, to roll over their whatever accounts to, something that's more conservative, like different index retirement accounts. But that's a whole another video, a whole another story. But IULs can serve as a good protection for this happening. This is why, actually, if we look at over the past 25 years of an IUL growth within the S&P 500, it's grown substantially well. So for the savvy people who want to learn how to leverage their IULs, let's talk about the loans. So there's two major type of loans. Doesn't really matter what sort of life insurance company you go with. Of course, every company has their different style or little like rules or regulations to them. But for the most part, they're either conventional, which are also called wash loans, which I'll explain why, and then there are index type loans. So essentially, the main difference between the two is that with conventional are when you borrow from, the cash value that's available, the cash surrender value that's available, the amount of money gets put into a side account where it gets credited a certain amount of interest, right? So remember, instead of it staying in that account where it stays within the floor and the cap, it gets moved to a little side account where it might make a fixed amount of interest, let's say 2%. So instead of the potential for it to grow in this range between 0 to 13%, the amount of money, let's say it's, 100 grand, gets moved over here to go for 2%. Now, oh man, it's knocked myself in the eye. But so as you take that loan out, it's growing over here. At the same time, people then ask, well, what's the loan interest amount? Like, how much am I paying interest on this loan? Well, for most companies in the conventional way, because it's safer, they have what's called, a guaranteed amount and then non-guaranteed amount. So the guaranteed max, once again, this is some companies, it's all different, could be 3%. So I'm going to put, interest, that's the percent sign. Let's say 3% max, right? And what some companies have it set up is, in the first maybe 10 years or so, the max is 3%. So let's say for years 1 to 10, the max could be 3%. But now, in the 11th year, they have more what's called like preferred, or it could change, right, based on the company. So let's say years 11 plus, their new max could be 2. So what does this mean? Why is this important? Because this when it gets to this range, if you think about it, when you took this 100 grand out of here, it's being credited at 2% or growing at 2%, and you're being charged in the preferred years 2%. So that means net, you're being essentially net charged zero. So imagine taking out $100,000 loan, hypothetical numbers, of course, could be anything, and paying 0% interest. Like if you're a business owner and you went somewhere to a bank or whatever lender, hard money lender, if you're a real estate investor, and you're like, and a hard money lender is like, cool, here's 100 grand. I don't need to see your credit. I don't need to know what you're doing, and don't even worry about charging interest. Like how incredible would that be? And this is why IULs are gaining so much attention, because when you set them up properly, you can take advantage of things like this. So you might say, well, how could it even get better, right? So the index part is where it can get better. So with certain companies, certain products, certain IULs, blah, 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 the index part, the loan. So remember, just a quick recap. To take the loan here, the cash, it came out of this account, the 100 grand, to grow on the side account. In the index part, the 100 grand that you take a loan never leaves. It stays right here to grow as normal with the fluctuation of the index. So what this means, and usually because it is more advantageous, because you could grow your money up to 13 whatever percent based on the company's cap, you could take a loan and still grow it up to that amount, which over here, yeah, that could only be 2%. So of course the interest rates here are going to be higher, but even if the max happens to be 8%, and then let's say it also has a stipulation of 5% in like the preferred years or non-guaranteed, and it happens to grow, let's say at a certain year, of 10%, what this means is your 100 grand got credited at 10%, that loan, and you were charged, let's say maybe 8% or even 5%. That means you took 100 grand loan and had a net growth of 5%. How crazy is that? So then this is where people are able to then utilize these loans to go cover different emergencies, expenses, or whatever. But for business owners and investors who are smart, they take this money right here and then they go invest it into some sort of an asset, right? That then they could make more money on. So then when that happens, they then, once they make their money, they essentially just plug it back right in to their account. And then once it grows again, they now take it again, go get another asset to make more money, and then just plug it back. And what happens is they keep repeating this process over and over and over again, accumulate more and more, cash flowing assets, and then eventually the cash flow from the assets could even cover the premium of the whole IUL, and then you just put the thing on autopilot, and eventually you'll have cash flowing assets, which could help supplement retirement. You might have some, standard traditional retirement accounts as well. Then you could also just use the cash value that's in here to supplement retirement as well, and then still have the protection of the death benefit to protect your family's income just in case something happens, and then to create generational wealth. And did I mention the whole time you When it's done correctly and you aren't completely surrendering it, you are not paying taxes on the growth the whole time. Because once again, imagine you go to the bank, you take a loan out. Did you pay taxes on that loan? On the mortgage on my house, they gave us a few $100,000 and I didn't pay income, no income tax or anything on that because it's a loan. So if you do it correctly, you can have protection for your family. You can have it for emergencies, have it for your kids' college, uh, cover weddings, start a business, rental properties, cash flowing assets, anything you could think of that you could leverage and use the money, you could do it and still have death benefit to cover, a legacy for your family. So these are some of the reasons why I have it set up for myself, my wife, our kids, and we first started with my youngest son when he was 4 months old. So we can just let that thing, like compound interest, take over, and just keep increasing it all along the way. So he has a vehicle that's meant for life and not just education or college. Because let's be real, it's easy to get funding for college. There's all these grants and things and that, but there isn't really funding for just like your entire life. So this is something that I hold true to my heart and my family. Something I take advantage of, and just want to spread the knowledge because these aren't things that honestly like we grew up in, especially depending on like the community that you're a part of, and like we aren't taught it in school or our parents or things like that. So this is why I like technology, to be able to step into this industry, years ago, really be able to learn a lot, and now that I'm able to give back. So once again, please like, subscribe, share the video to help the channel out and help us to spread more knowledge to help more families, more businesses, more investors as well, so we can get this economy back to where it was decades ago. So once again, Marquez Fernandez, thanks for watching and stay tuned for the next video.